$10,000 right now in Australia. What would I do with it? I wouldn't chase hot stocks, I wouldn't touch crypto, and I definitely wouldn't let it sit in a savings account while inflation quietly destroys it. Here's my exact plan, step by step. Before I tell you where the money goes, here are 3 rules. Rule 1. Keep it simple. Own the market. Don't try to beat it. Rule 2. Think long term. This money is for 20-30 years from now, not next year. Rule 3. Minimize fees and tax. Every dollar saved compounds into thousands later. Here's the split. 4 moves, 1 portfolio, built to grow for decades. First, $4,000 into VGS. That's the Vanguard International Shares ETF. It holds roughly 1,500 companies across the developed world. The US, Japan, the UK, Europe. Think Apple, Microsoft, Toyota, Nestle. This is my global growth engine, and it's Australian domiciled, so no US estate tax headaches. Next, 3,500 into VAS, the Vanguard Australian Shares ETF. This tracks the top 300 companies on the ASX: Commonwealth Bank, CSL, BHP, Wesfarmers. But here's the real kicker: franking credits. Australian companies pay tax before they pay dividends. When those dividends hit your account, you get a credit for tax already paid. For Australian investors, especially in lower tax brackets, this is genuinely powerful. 1,500 into VGE, emerging markets, China, India, Brazil, Taiwan. These economies are growing faster than the developed world, but they're more volatile. That's why only 15%, not the main course, the side dish. Over 20 years though, that growth matters, and it means I'm not just betting on America and Australia. 1,000 stays in cash. Wait, cash? Yes. Here's why. This isn't your emergency fund. That should already exist, separate from this 10,000. This is opportunity money. When the market drops 20%, you have dry powder to buy more. Psychologically, it stops you from panic selling your other holdings when volatility hits. You have something you can do without wrecking your strategy. Now, how do you actually buy these? Use a CHESS-sponsored broker. That means you legally own the shares, not the broker. Good options: Stake, CMC Markets Invest, ComSec, 3 buy orders. Total brokerage probably under $30. That's 0.3% of your portfolio. Acceptable. Place the orders. Done. Let me show you why this matters. $10,000. Average return of 9% per year. That's roughly the historical long-term return of global shares. In 10 years, 23,700. In 20 years, 56,000. In 30 years, 132,000. And that's if you never add another dollar. But if you add just $500 a month, less than a car payment, in 30 years, you're looking at over $1.1 million. That's not a get-rich-quick scheme. That's just math, time, and consistency. But what about property? $10,000 won't get you a deposit in Sydney or Melbourne. Start here, let it grow. What about picking individual stocks? Master the basics first. ETFs let you own thousands of companies without reading a single annual report. Should you wait for a crash? Nobody knows when it's coming. Time in the market beats timing the market. Every single time. So that's it. 4 moves, 1 portfolio, built to grow for decades. If you found this helpful, hit subscribe. I drop new videos every week on building wealth as an Australian, without the jargon and without the hype. Drop a comment below. If you had $10,000 today, would you follow this split? Or would you do something different? I read every single one. And if you're watching thinking, I don't even have 10,000 yet, don't stress. The next video is about building your first 10,000 from zero. See you then.